Hello everyone, this is Ricey and welcome to my channel, The Quest for Wealth. Before we move on with this video, I wanted to remind everyone again that this video and this channel is not a recommendation in any kind, shape, or form on what kind of investments you should venture yourself into. Investing is a serious journey. It's a very personal journey, and therefore you cannot make an investment just by merely watching one video. So CIBC have just recently launched a kind of stock, which is called CDR. CDR is Canadian Depository Receipts. So Canadian Depository Receipts is patterned after American Depository Receipts, and American Depository Receipts had been quite remarkable and successful in the US stock exchange. So American Depository Receipts, whenever you buy Alibaba shares, you don't necessarily buy the Alibaba stocks directly. You don't own directly the Alibaba stocks. What you own are the American Depository Receipts, and these are primarily, or this is, shall I say, primarily the same idea or concept of CDR. Before we go on to diving deep into what exactly is a CDR, let us move back a little and truly discuss the issues that Canadians, or for me personally, the issues that I face whenever I buy US stocks. The broker that I use, or that I am with, is called Questrade, and Questrade is pretty popular in Canada. As a matter of fact, I am an affiliate of Questrade and I will link that affiliate link in the description box. If you ever decide to open an account with Questrade, you will receive a $50 rebate with them moving forth. Now, whenever I buy, being a person living in Canada, whenever I buy US stocks, what happens is that since I have Canadian dollars, I do not have any US dollar account. Since I have Canadian dollars, I will have to exchange my Canadian dollars to US dollars, because these US stocks trade in their denomination, which is the US dollars, or in their currency, should I say, which is US dollars. And there are various costs involved whenever I exchange my Canadian dollars to US dollars, and these costs affect my buying power and my returns. For example, whenever I exchange Canadian dollars to US dollars, there is a commission involved. So Questrade would charge me a commission. That's one. And the second one is there is the volatility or fluctuation of the exchange rate between Canadian and US dollars. Who knows if the Canadian dollars will move up or down in the next days. Therefore, what happens is that there is a certain spread that whatever is most favorable to you, you have to take it. And there is this potential of loss to the investors again. These things truly is whenever it accumulates, because I do not only buy one, I don't only buy one US stock. There are other US stocks that I buy, and whenever I exchange, I lose so much amount of money. And these two things are the various questions, are two of the questions that I've been thinking. I hope to not lose so much money, and therefore CIBC and Neo Exchange had essentially released these CDR. So what exactly is CDR? CDR essentially allows Canadian to buy US stocks in the local stock market using Canadian dollars. So then those two issues that a retail normal investor such as myself face are essentially resolved with the CDR. So then CDR is traded on the Neo Stock Exchange, and the Neo Stock Exchange essentially is pretty much like TSX, only that Neo Stock Exchange is very young. It's only about 5 years old, and CDR is absolutely new. It was released back July, end of July. The first set of CDRs were released back end of July. So it's only been really 3 months now that these CDRs are being traded here in Canada. And if you will have a look on the various CDRs such as Tesla, your Apple, Microsoft, Facebook, and Visa, I believe there's also Disney. This company's trading volume is not a lot yet because it is absolutely new. Aside from those two issues that are beneficial or advantages of CDRs is that CDR is CAD hedged. When we say CAD hedge or hedge in general on financial assets, hedge means reducing risk on financial assets. So then with CDRs being CAD hedge, the returns on the CDRs does not take into account the volatility of the US and Canadian dollar exchange rate. The returns of CDRs are directly related to the performance of the underlying stocks, and the underlying stocks are essentially the stocks that you buy, whether it be Apple or Microsoft or Facebook. So however these stocks perform in the stock market is how your CDRs will perform. It doesn't matter how volatile the exchange rate between Canadian dollars and US dollars is. That is the third advantage of CDR. And I would say the fourth advantage of CDR is that investors or retail investors can essentially buy fraction of a share. Take into account the cost of a share of Amazon, let's say. Amazon trades at more than $3,000 a share. Google trades at more than $3,000 a share. Tesla trades at more than $1,000 a share, or by the end of the filming of this video, perhaps it will be trading at $2,000 a share. I don't know. Gee, who knows these days? But this cost per share or per stock really is a lot. It is something that me as a retail investor, I truly cannot afford it. Even then, this cost of these prices of these stocks are so much, and therefore CDR was launched at around 20-ish per CDR. According to CIBC, the first launch or the initial launch of CDRs will be priced at $20 per CDR. And this $20 per CDR is a fraction of a share, and thereby allowing retail investors to afford to buy this huge, great performing US tech stocks. And since the CDRs were only 3 months old now, you will find that most of them, or even not necessarily all of them, Tesla's, as I saw yesterday, is already trading at more than $30 a share. I believe it was $33 a share. But then the rest of them, the Facebook, the Microsoft, and the Amazon, and everything else, they are all still trading at the 20-ish neighborhood per CDR. And since CDRs are very new now, they're only 3 months old, again, you will find that the trading volume is very low. And this is a disadvantage for the time being. This is definitely just for a short term. But this is also an advantage to investors, because then there is a bigger spread when it comes to the ask and the bid. So then if you are a buyer who wants to buy any sort of available CDR, you do have the power on the bid whenever you want to buy any kind of CDR. So I see that as an advantage to investors. I have been establishing my position on the various CDRs, not all of them, of course. I want to truly focus on 3 CDRs and focus my resources and my energy and my money on buying those 3 CDRs. And so far, I have been quite successful on some of my bids there, and therefore that I would say is an advantage for now. CDR being new, not a lot of Canadians perhaps is aware of its existence as yet. If we take into account the success of ADRs thus far in the US, I can only imagine that CDRs can reach so much success as well here in Canada. Of course, the trading volume will not be, I cannot truly imagine the trading volume to be pretty much the same as ADRs. I mean, US is the biggest stock market in the world. The economy of Canada is a little or very little when it comes to if we compare our economy to the US. Nevertheless, if the concept of ADRs and CDRs are the same, then I can only imagine, and I truly believe really, that CDRs can have the same success here locally. So those are the positive or advantages of owning or buying CDRs. And in every single investment, as I always believe and I always say, there are always the positives, there are always the negatives. So now we tackle the negatives of buying CDRs. One disadvantage worth mentioning is, according to Investopedia, ADRs are issued with the most standard ratio of 1:1. This standard ratio of 1:1 means that in every single ADR you buy, you have got one ownership of stock of the underlying company. But then some will be issued as a fraction of a share. It could be 10 ADR per one share. So then 10 ADR means you own 10% of one single share. Nevertheless, the idea is that the fraction is fixed. Whether it be 10% or 20% of a certain share, it is a fixed ownership of a stock. But this is not necessarily the case with CDRs. The CDR ratio is automatically adjusted according to how strong or weak the CAD against the US dollars. This therefore means that if Canadian dollars is stronger than US dollars at a certain day, and then your ownership of CDR increases, and if the Canadian dollars becomes weaker compared to US dollars, your CDR is automatically adjusted, and therefore your CDR ownership drops. That is one of the disadvantages, which is it's not a fixed ratio as compared to some ADRs in the US. And the second disadvantage, I would say, is taxation. Unless, of course, you buy these CDRs on your registered savings accounts. Now, one thing is that with your TFSA is not a registered account in the US, and therefore it is taxed in the US, meaning your gains are taxed in the US. But then here in Canada, since it is a registered account, we are not taxed on the gains of TFSA. So then I guess that is one factor that you also have to consider if you buy these stocks under a normal margin account, a normal savings account, or a normal investment account, which is a non-registered savings account. And then there is the possibility of double taxation. So you will have to speak to your accountant, or for yourself, truly understand for yourself where is the best place for you to invest your which account it is best for you to buy this CDRs on or under. And another thing is the management cost. Actually, this is not necessarily a bad thing, because the management cost, the company or CIBC does not necessarily charge management cost as compared with mutual funds. The mutual funds are essentially charged MERs, or management expense ratio, but with CDRs, there is no such thing. They do charge 0.6% for automatically adjusting the CDRs, and that's about it. And 0.6% really is not a lot. It's not something that would have an adverse effect on your returns or on your buying power. 0.6% to me at least is acceptable, really. So those are the definition. That's the CDRs in a nutshell, and the positives and the negatives. Again, this is a very new concept, or this is a new launch now, and therefore the trading volume is very low, and Canadians will be more receptive of the idea of CDR. CIBC said that they will be launching more CDRs into the stock market. I believe that that's worth looking at and following. Again, as I always say, do not invest or buy any stock or any security just because you watch one video. You have to do your own due diligence. You have to do your own research. Thank you for watching this video. I hope you gained value in this video and in my channel. If you did, please click like, share, and subscribe. And also, if you wanted more savvy tips on investing and saving, check out my website here. And I will also link this in the description below. You can also subscribe on my newsletter so that you're aware on the various articles that I write. I have not been active on that as yet, but I certainly will be active on writing articles in the future. Thank you for watching this video. I certainly hope to see you on my next video.